Investing in Switzerland is one thing, but paying tax on your investments, that's where most people get stuck. So we have wealth tax, dividend tax, capital gains for some people. It feels like a secret language no one ever explained. So in today's workshop, we're cutting through the confusion. So you will discover the hidden rules of investment taxes in Switzerland that most people miss, and how dividend, ETFs, and capital gains are actually taxed, and the number one mistake investors make when filing and how to avoid it. And plus, we have a live step-by-step tutorial on how to file your investment taxes yourself. So if you ever wonder, am I doing the right thing? So this is the session you can't afford to miss. Hello, everyone. Welcome to today's podcast, or let's say workshop, on investment tax in Switzerland. And I'm so happy to introduce to you my special guest, Kevin Walz. And Kevin has over 15 years of experience in taxation with a background in tax authorities, a Big Four firm, and banking. And he's currently independent, running his own tax advisory firm in Switzerland. And today, hello, Kevin.
Hello, good morning.
Hey, morning. And today our focus will be on investment tax, and Kevin will also walk us through a brief tutorial on how to file your investment tax return step by step. Okay, Kevin, maybe we can just quickly, jump into the first question that we prepared for you. When it comes to investment tax in Switzerland, people, we naturally talk about, capital gains, dividend tax, and how to optimize your tax and tax returns and so on and so forth. And maybe let's just touch on the returns first. When it comes to return, and of course, we know we mainly have capital gains and dividend, interest, and so on and so forth. And is it true that capital gains from private investments in Switzerland are tax-free, right? And what are the exceptions? Maybe we can start from here.
Yeah, perfect. Yes, it's correct. Capital gains on shares, funds, ETFs, cryptos, all that kind of stuff are tax-free. The only thing that Switzerland taxes in this respect are capital gains on zero bonds, because there the price gain is kind of a form of interest. In addition, Switzerland taxes capital gains on real estate located in Switzerland at the time of sale. But when we're talking about normal investments, capital gains, private capital gains are taxed.
So we're not talking about, for example, if you're a professional trader, right? And that's capital gains that you have. Normally, you probably need to pay taxes kind of like your normal salary or income. And we'll touch it a bit later as well. And when you talk about real estate tax, I heard it's quite high, especially in Switzerland, especially when you buy a real estate and then in 2 or 3 years when you try to sell it, the tax could be quite high, right? But if you hold it for a bit longer, the tax tend to kind of decrease as.
Yes, exactly. That's a general rule, like that the tax could be lower the longer you hold your property. But there are a lot of differences depending on the canton, because it's just a cantonal and communal tax. There's no federal tax on that.
Unrealized.
Canton has its own rules. Usually you pay less tax if you hold it longer, and usually you also pay less taxes if your earnings are lower. So the tax rates are in most cantons progressive.
Okay. Yes. Cool. Good to know. And maybe we can talk a bit more on dividend as well. I think a lot of people, when it comes to dividends, like for example, before I was in Switzerland, I was actually in Hong Kong. So in Hong Kong, and normally we don't, dividend tax or interest overall, this kind of income tax, it's not taxed in Hong Kong or in a lot of other countries as well. But in Switzerland, it tends to be a little bit different. And then it may affect your investment decisions as well. And maybe, Kevin, you want to quickly touch a bit on that as well, like how are dividends from Swiss versus foreign stocks taxed, and can, for example, investors reclaim foreign withholding taxes? And maybe you can also explain to us what are foreign withholding taxes, at some point, if you want to touch on this point.
Sure. So yeah, as we already said, Switzerland taxes dividends, so they are taxed like a normal income, like your salary, for example. So the dividends are fully taxable regardless of its origin. Some countries withhold taxes based on their local tax law. The US, for example, with most of these countries, Switzerland does have a double taxation treaty. This means that you usually can offset the foreign taxes against your Swiss tax burden. In most cantons, you can choose if it should be offset against your taxes or paid out separately. The result in the end is the same. The withholding tax in most countries is 15%. Please keep in mind that if your tax burden in Switzerland is lower than 15%, you will only get back your effective tax burden, not more.
Yeah, but it's very unlikely, right? Lower than 15% in most cantons in Switzerland.
Yeah, it's rather unlikely, but if, for example, in a year you're doing some renovation on your property, which lowers your taxable income, it can be that your tax burden
some exceptional cases. Yeah,
exactly. And then also Switzerland has some kind of a withholding tax on their dividends and interests if they reach a certain amount. It is 35% and called Verrechnungssteuer. That sounds very high, but you get the full amount back if you declare the dividends and interests properly in your tax return, and then your normal overall tax rate is applied on this income.
Yeah, it's very clear. And maybe Kevin, I know our audience, sometimes it could be very confused, very confused for, those beginner investors, when it comes to some terms. Maybe you can quickly explain to us what is withholding tax, maybe like in a really simple way. What would you say?
So withholding tax in general is just a tax which is, withheld. So a so-called tax at source. So when you, for example, should receive 100 Swiss francs as a dividend, your bank will only pay out 65% and withhold 35% in case of the Swiss withholding tax. And then with your tax return, you receive back those 35% that has been withheld. And
it's a very good example. And when you do, like, for example, if we're currently, I think most of our audience here are in Switzerland, if you want to invest in the US stocks, for example, if you invest in the US S&P 500 ETF, and then there are a lot of companies that pay you dividends as well. And in the US, for example, the government will withhold like 15% normally, right? And for example, if the ETF should pay you 100, but in the end you only receive 85. So, and then you have to do some claim, by the end of the year to make the Swiss government know that, okay, here is 100 is the dividend you should have received, but you only receive 85, and then the 15 is with the US government, and then there's some reclaim, they give you back, or it depends on different situations. And Kevin will touch on it later, and then we'll show you by the step-by-step tutorial as well. And Kevin, maybe we can move on to the next point about ETFs and tax efficiency. So I think a lot of our again, students or audience, some of them, they keep asking, yes, we invest in stocks or ETFs, but when it comes to, for example, ETFs, they are, the same underlying assets, let's say S&P 500, right? So you can purchase the S&P 500 in the US stock exchange, right? You can also buy an index, let's say a passive index funds in, let's say, Ireland fund, or you can buy a Swiss franc hedged S&P 500. There's so many different choices. I would say, different share classes in finance, with what we call them. So from a tax efficient or tax efficiencies perspective, can you maybe let us know, are some ETFs more tax efficient than some others for people who live in Switzerland? And what should you, or what would you advise people like us watch out for?
Okay, so basically ETFs or funds in general are kind of a basket of shares and other assets. So if the fund contains many investments that distribute taxable income, like dividends, these are also taxable even if they are reinvested by the fund. So if it's an accumulating fund, so from a tax perspective, it would therefore be more attractive to invest in funds that are invested in non-distributing investments, as the capital gains, as we already discussed, are tax-free.
Yeah.
It can also make sense to invest in funds that are domiciled in countries that do not deduct a withholding tax, for example, Luxembourg. Not because it's less expensive, but it just saves you the time or the expense of reclaiming the tax and the risk that you will not be able to reclaim some of it, as we discussed with the property renovation. So just saves you some time, but it's not.
It's I know what you mean. It's not theoretically, it doesn't mean it could be more tax efficient if you invest in a fund, like for example, based or domicile in Luxembourg. But practically, you save time, and time is money. Effort is money, right? Do I understand correctly?
Yeah, and also I think taxes are not the most important topic when it comes to investments.
Yeah, I can't agree more, because we have a lot of students or audience, like for example, they I'm an investment coach, but I think a lot of people, they know more than I do when it comes to like tax. They're like, oh, this ETF is better than that because it's cheaper. But you always need to put your investment goals first, construct your investment strategy based on your personal goals, and then you start to optimize it. Otherwise, you will optimize an investment strategy that just doesn't really fit you. It's really, the other way around, is you really should focus on the most important thing. I totally agree with you, Kevin. And when you mentioned the capital gain or accumulated shares and distribution shares, you just make it very clear that no matter you invest in accumulated share or distributed share, you pay basically, it's the same. Some people thought, okay, if I do the reinvested, if I do the accumulated shares, I pay less tax. It's not true. So you pay exactly the same, because even though the shares or the dividends are reinvested, and in order to avoid it, you can focus on, for example, like more growth-oriented assets instead of dividend-paying assets. I just want to repeat here to make it clear. Good. So good to, I would say, to clear a lot of misunderstandings around, this thing. Okay, Kevin. And we just mentioned, like, for capital gains, and there's no capital gain tax in Switzerland, right? And naturally, for realized and unrealized gains is not tax for private investors, right? Do I understand this correctly?
Absolutely, yeah. There's no tax at all on capital gains for private investors. It only has an influence on your wealth tax, of course, because the wealth tax depends on your wealth at the end of the year. So if the value of your assets is higher at the end of the year, also your wealth tax is higher. Also, the tax rates here are progressive, so the higher your wealth is, the higher is your wealth tax. But we are only talking about 0.1 up to 0.2% usually. So it's
So it's
really,
still kind of relatively manageable. Like, for example, if you have 1 million and 0.1% is 1,000 to 2,000, if you're talking about 0.2%, right? Okay,
exactly.
that's still kind of is still some money, I would say, but it's relatively manageable unless you're really multimillionaires, billionaires, and yeah, maybe it will kind of like influence you quite
Yeah.
bad when you reach that level.
Yeah, I think for the multimillionaires, it's also manageable to pay the wealth.
You are right. When you have 10 million, I mean, you don't care those few thousands, right?
Yeah,
There are some,
yeah,
yeah.
but also it doesn't matter if you have your money just on the bank account or you're making investments. It doesn't matter. You pay wealth tax either way, so it should not have an influence on your investments.
Yeah, definitely. Yes, like Kevin, we mentioned like capital gains basically normally is not taxed for private investors. But we just like mentioned the exceptions, right? If you are, for example, reclassified as a professional trader, then it is like it's just the case that you need to pay tax on that. So I wanted to know. I think a lot of people would like to ask, like, there's always a balance, right? At what point might an investor be considered a professional trader instead of a private trader, and you have to pay tax on capital gains?
Yeah, so there's actually no basic rule at what point that you are considered to be a professional trader. So
So it can be very subjective. I say you are a professional trader, then you are.
there's not
Okay.
like a limit after a
Hmm.
certain amount of capital gains that you reach that you're considered to be a professional trader. The focus is usually on the number of trades per day or per
Okay.
year. So the higher this number is, the more or the closer you are to a professional trader. However, it is relevant, for example, whether you have also borrowed some capital or you only manage your own existing assets, or your professional proximity to trading is also taken into account. So if you're a banker, for example, it is more likely to be considered a professional trader than a baker or
Okay. A banker
yeah,
versus the baker. Yeah.
yeah. So and it is also assessed whether your investment activity would be suitable for financing your living, your livelihood. So anyone who trades excessively with, let's say, 30,000 Swiss francs is almost certainly not a professional trader, because you will not be able to finance your living with that.
Yeah, given that in Switzerland the living cost is very high.
So in general, however, it can be said that it's extremely rare for someone assessed as a professional trader. I
Okay.
think in about 15 years, I have only ever had one case on my desk where this was actually an issue. We're still waiting for the decision. Um,
Okay. Yeah.
but yeah, usually it's just considered as a private
Yeah,
private.
like normal people, for example, if you're, we have a lot of students, for example, you have a full-time job or even 60%, 80%, like working for a corporate, and then on the side, you buy some, even you, sometimes you trade quite frequently, like for some certain stocks or ETFs, you are a private investor. Don't be, don't worry too much, right? Do I?
Yeah, and the tax office usually only sees your assets, your holdings at the end of the year anyway, in all those statements, and therefore don't necessarily see at first glance whether it has been traded a lot or not. So where could they know that from? Yeah, but on the other side, I think trading has developed enormously, thanks to online banks and also things like structured products and derivatives are now relatively freely and easily accessible or available to normal private investors. And I think that could lead to changes in the future, but yeah, I don't know yet.
Yeah, it's like no one has a really crystal ball, but it's really good to know that unless it's really kind of like an extreme case, like you live on your profits as a trader, you do it as a full-time job, and you earn quite a bit. You do a lot of trades every single day, and otherwise, we are all classified as a private investor.
Yeah.
Cool, Kevin. And now we are going to the quite exciting part. We're talking about brokers or investment platforms. And, when it comes to tax or investment tax in Switzerland, I think a lot of people would think, and which is also true more or less as well, there are certain platforms that make tax reporting or the overall things a lot easier. And there are some platforms, maybe, they charge you slightly cheaper fees, but it tends to kind of like cost you quite a bit more time when it comes to the year end when you need to file your tax. Maybe you can quickly touch on, Kevin, like which brokers or platforms here, make it easier or easiest for Swiss tax reporting and compliance. And I know later on we will also share screen and walk our audience through, how to do it step by step.
Yeah, so you already said some or mentioned some points. When it comes to the declaration, it is by far the easiest to invest at the Swiss bank, because Swiss banks must provide you with a tax report that clearly shows the taxable income and the value at the end of the year. Although this usually costs a little at most banks, but it's
for example, you need to pay 100 or 200 to have this statement, right?
Yeah, because it's only mandatory to provide you with a report, but not with a tax report, and the tax report costs then. But it saves you so much time, and also you don't have the risk to miss anything or to declare too much of income or too much value. It's not that you can't prepare a tax return with the reports from foreign banks, but the report is simply much higher, and you need to get into the details. Because some of the income and assets shown in such reports are not really taxable in Switzerland. So it takes a little more time and a little more know-how to do so. But I can quickly show it to you.
Yes, it's the exciting part. I'm so looking forward to it. So Kevin, today and basically now he will walk us through actually 3 different banks or 3 different investment platforms, and 2 in Switzerland, and one include Swissquote, and then the other one I know a lot of our students or audience that use interactive brokers. So we'll also walk you through that as well. Okay, Kevin, are you ready?
Can you already see my screen? Now it should be visible, right?
Okay. So tell us what you are currently showing us.
Okay. So this is just the demo version of the Zurich tax return. As I already mentioned, each canton is a bit different in Switzerland. But in general, it's the same. It's just looks a bit different.
The layout.
But yeah, basically it's the same.
Yeah, they should make the same. They can save some money for the web design or the system.
But,
okay, it's another topic.
Don't discuss this topic with me. Yeah, it makes my life a bit harder as well.
I know.
So what we have here is the so-called, in German it's called Wertschriftenverzeichnis. So it's just the overview of your asset and the income from assets. And we need to separate your normal or your Swiss assets, your Swiss bank accounts, and the accounts that have a foreign withholding tax on it. Because to claim that money back, to claim this withholding tax back, you need additionally to report or to complete the so-called DA1 form. But this is all here. So I will guide you through it.
So cool. So basically, there are just a few numbers you need to calculate or you need to get directly if the investment platform allows you to do that. And it's mainly like what Kevin explained, the total asset value, right? And the income, the income you receive in Switzerland and then outside. And within Switzerland is the income with withholding tax and income without withholding tax. And for the foreign one, it's also income with withholding tax and then in the income without withholding tax, right? Excellent. Just like these few numbers. And now Kevin walk you through how can we directly get or calculate these few numbers that we just mentioned.
Exactly. So here's a statement of a Swiss bank, which makes it really easy to complete the tax return. So
it's the local bank in Landsberg. Okay, cool.
Yeah, exactly. So just to show you this, the statement has a lot of pages, but you basically only need the information on the first page, because this already shows you the total of assets you have. In this case, 15,365 Swiss francs. And this is split up between assets with a withholding tax in Switzerland, without withholding tax in Switzerland, and here the foreign assets with a foreign withholding tax. Or this is the income and this is the withholding tax. So when it comes to the reporting, important to know is that you can only claim back a foreign withholding tax if the total of those withholding taxes is more than 100 Swiss francs.
On a yearly basis, right? Yeah.
Yes, at least this is the rule in most of the cantons. Maybe there are some exceptions, but it's just, it would take too much time for the tax authorities to review those DA1 statements for just to claiming back like 10 Swiss francs. So that's it's not written somewhere in the law that you need to reach that amount. It's just something the tax.
You spend like 3 hours to the calculation. In the end, claim like 10 francs back.
Exactly. So here, for example, we need to keep those numbers, or let's make it that way. Let's open that. You can add here a normal bank account or this deposit statement, and you could also, which is also a nice thing, and which is also a benefit from Swiss banks. You can just add your Swiss bank statements because they have these QR codes here. So you could just take this statement, put it in here, and they will complete the form for you. So, so this would be the easiest way. The other way is to add it manually, which is easy as well.
Okay.
So, so this is for the Swiss assets. You have the total value of your Swiss assets here.
Yeah, the total value.
So it's 855 plus the 13,000 here. The reason, because they have two different pillars here, is that some cantons have other forms where it's split up. In the case of Zurich, it's just the total of your Swiss assets.
Yeah, you just added up the two numbers, basically, right?
Exactly. So anyway, I didn't calculate it in detail. It's about 14,500. And now you have the income with Swiss withholding tax, and here the income without withholding tax. So it's 71 Swiss francs and 63.
63, yeah, with and without, yeah.
And here important is that you always declare not only the net income, but the whole amount that you should have received. So if the dividend would have been 100 Swiss francs, but you only received 65% of it, you still declare the 100 Swiss francs here. This is also the amount that it's shown on
Here,
the
directly.
statement.
Okay.
So you usually should not make a mistake here. But if you only report the net amount, it will calculate the withholding tax wrong.
So here it should be the amount that you should have received, but not yet received fully.
Exactly. You can also upload the statement here. I usually recommend that. So just in order to avoid any questions from or any requests from authorities, it just helps them to review your
if it's correctly done or not. Okay. Yeah.
So this is the Swiss part, and
it's quite straightforward, right?
It's quite easy, yeah. And then we have the part to claim back the foreign withholding tax, and this is the form DA1.
Yeah.
Here you could add, when you only have like one share in the US, you could just add this, let's say, Alphabet share or whatever it is here. But in our case, we have this whole deposit statement with different assets. So we need to add here Depotsteuerauszug, which is just a deposit report. And then it's basically the same as we already did for the Swiss asset. You need to add those. You need to add here if it's dividends or interests. Doesn't really matter. And then also here you can add the total of assets. Is this amount here, 557 Swiss francs. Then the income you had, which was 9 Swiss francs. This is the amount you found here. And here the foreign withholding tax, which in this
the 9 is that you should have received fully, but maybe you only receive 8, right?
Yeah, exactly.
But you should put 9 here and 1 there.
Yeah, exactly. So that's it. Here I really recommend uploading the statements because they usually only pay it back when you have proof that there was a foreign withholding tax.
Yeah, exactly.
With
that's it.
Statement. So it's really straightforward, really easy. It's the same for an Swiss online bank like Swissquote.
Swissquote, yeah. Let's do a quick run here as well.
You just find the relevant information here at the bottom of the statement, usually at the last page, in this case at the last 2 pages. It's also here, it is split up between Swiss income with withholding tax, with this Rechnungssteuer, and the assets without withholding tax. Here you have it's split up between Swiss assets, German, Italian, US assets. That's not really important. It doesn't really matter. If it would have been only Swiss assets here, it's basically the same as we reported for the Hypothekarbank Lenzburg. So it's just the total of assets that you could report.
Yeah, we should first put the total amount, which is 41K here, right? It's the total, including both Switzerland and international.
Yeah.
And then we split into two parts on Switzerland and international. And then
exactly. So the Swiss part is really easy. Swiss part is just in this case. This is
945. Is it this one?
Yeah. 945 is the wealth at the end of the year, and then your income with withholding tax is 20 Swiss francs.
Yeah. And the 7 is the withholding tax, or
I think that's 35% of those 20.
Yeah, 20. Yeah.
And then you have all the foreign assets. As you see, not a lot of them really have a withholding tax. So the withholding tax would be here. So we only have one for Germany in this case, and here for the US. As we already discussed, it's 15%. So 15% of 100 Swiss francs of dividends is 15 Swiss francs. So the system here would be the same. These are your assets, except
total assets internationally. Yeah,
exactly. So you would just need to add them, same as we've seen before. Just here, Swiss quote. It's also dividends here, and then it's, I think it was like 40,082, and the income we found here. So it's 158.
That's 158. That's the without withholding tax.
That's with the foreign withholding.
Okay, yeah, okay.
And then the tax at source was 20.
Yeah, withholding tax is 2084.
Yeah, that's it. Also here you could upload the statement. I think the bank statement from like normal banks in Switzerland and the online banks like Quote are quite similar, quite straightforward. It gets a bit more complicated when you trade, for example, on interactive brokers.
Yeah, okay. Now it's a little bit complicated if you use interactive brokers, but let's see how we can simplify it with Kevin.
Yes, because they also provide statements that are called tax statements, for example, or other kind of statements, but these are not like Swiss tax statements. So it's not based on Swiss tax law. It's based on the local law of each bank. So when we have the statement here, we need to get a little bit more into the details to make sure we don't declare too much. So the first thing that you need to check when you have such a statement is this one here. What is the base currency of this statement? Because for most of my clients, it's usually US dollar. You need to change it to Swiss francs. And first, I can show you that as well. But here it is Swiss francs, so it's fine. We can work with those values we find on that statement. In most cases, you can just work with this ending value we have here, those 300.
Yeah, that's the total assets, right? Including every single stock in Switzerland and internationally.
You also find that the same amount here, so this should be similar every time. But as you see with the small x I have here, there's an issue.
You put it there, right?
Yeah, I put it there. That's not the
okay. That's not the system. Okay.
Yeah. So sometimes you find on those statements, you find dividend or interest accruals. So interests that are not realized yet, that are not added to your bank account yet. And from a Swiss tax perspective, they're also not considered as a value. So this is not a taxable value. So you need to deduct this amount when you prepare your tax return. In this case, only the 303,000 would need to be declared as a value. We have a look later at the tax return.
Yeah.
So this is the second point. So have a look at the value shown if there's any dividend or interest accrual that needs to be deducted. The second point is the dividends. You find the details on this page here. So it's usually split up based on the currency. So if it's Swiss francs, euros, or USD, I think now you should see it properly. And the most important part is usually when it comes to the dividends, the Swiss part, because normal dividends are taxed, as we already discussed, but Switzerland has something called return of capital. In German, it's called Kapitaleinlageprinzip. So this is basically, these are not earnings from the company that are distributed. This has been money that has been brought into the company, now is distributed, and therefore it's not taxed in Switzerland.
Yeah.
So if you would only take the total amount shown on the statement, 4,150 Swiss francs, this would be too much. We need to...
Yeah, you will pay more tax, right?
Exactly.
You need to deduct that in order to save some money for yourself. Yeah, although the number usually is not that high, relatively speaking, right?
Yeah. It's not that high, but I mean, if you have a lot of those shares, it can reach a certain amount.
It depends on what you invest. Yeah.
And yeah, maybe as a short confirmation, you can always compare here. Here's the withholding tax. And you see here, there's a withholding tax on those 0.78 Swiss francs, also on this amount, but there's no withholding tax on that
for this
return.
one. Yeah, okay.
So this is also like a sign that it's probably not taxable.
Yeah,
You find also the details regarding the interests here. Usually that's not something you need to review. You can just take this amount. So let's get into...
Let's do a bit calculation now.
Here it's quite easy because there's, as you may have seen, there's only a Swiss withholding tax in that case. So it's only...
Oh, okay. They don't have the US, for example, right? Okay.
There were some dividends in USD.
US, yeah, okay.
They did not deduct any withholding tax. The reason could be that this person has a tax filing obligation in the US, for example.
Like a US citizen, for example, right? Okay.
So they are not withheld any
they
tax.
just pay it out, and then they need to file a separate tax form in the US. Okay.
In the US, yeah. So that makes it easier, but let's switch to the tax return. So for the Swiss part, it would be just the same as before. It's okay, yeah. So we have the total value here. In this case, as we discussed, it's not 304,000, it's only the 303.
Yeah, so 304 deducted by the like 300 something, right? Because
Yes.
deduct by the accruals. Yeah.
Exactly. And then also for the dividends, it's not the total amount, it's only...
Okay, it's not 450, 150.
Yes. So here we need to get into the details because
Yeah.
this is the Swiss portion. On this, we have the Swiss withholding tax. And as we have seen, we have the income with
1,200. Yeah.
and without Swiss withholding tax. So it's not 1,226 that we report here. It's, let me calculate it.
Is this number deducted by 107?
Yes, exactly.
Yeah.
Which is 119.
Okay, 1119. Okay, 08.
That's it. And then we have the income without the withholding tax. In this case, not only without Swiss withholding tax, but without withholding tax at all, which is this amount here. Like these are the dividends in euros. Then it's this amount here, which are the US dividends. And here, important that you take the right amount. It's always the amount in Swiss francs and not
Swiss francs.
the original currency. And we also have the interests plus 3.5 Swiss francs. So this is the total amount that needs to be added here as an income without withholding tax.
Like internationally. Okay.
Yes. So let's quickly delete some things that we did not add. Yeah. So here we see, for example, you have like the Swiss part of your assets, and here you have the DA1 form in order to claim the foreign withholding tax back. So it also shows you here what your income was and how high the foreign withholding tax was. If you would try to submit this tax return as it is, there would pop up a window because the withholding tax in that case is only 22 Swiss francs.
Yeah.
And as you see here in this red field, it already says if it's below 100 Swiss
100,
francs,
yeah, you cannot get it back.
get it back. And in that case, you could just add this amount to the rest of your statements. So, so here, for example, for Hypothekarbanklehnsport, you would just add 15,365. And this is still the same amount here for the income with Swiss withholding tax, but we have a higher amount of total income in without withholding tax, as here they added to the 63 Swiss francs, also the 9 Swiss francs with the foreign tax, which we cannot claim back here as it's below the 100 Swiss francs. So in that case, only the bottom line is necessary.
Yeah. Yeah, I hope, everyone, definitely I learn a lot, from this little tutorial. And I hope, our audience, definitely, I believe you do as well. And maybe just one thing to add, I think it's kind of like always a trade-off, right? And I know some international brokers, they may give you some really nice, attractive fees, right? But at the end of the day, depends, for example, if you have a really simple portfolio, this kind of tax filing could be, quite simple as well with those international players. But if you have, a little bit complicated here and there, maybe you should engage a tax advisor, or if you want to learn, it may cost you some time. So it's kind of always a trade-off, I think.
Yeah, and I think for Swiss banks, it really makes sense to buy this proper tax report, because usually
Okay,
it's
with
not
100 or 200.
because when you have a look at the statement, where was it? Like here for interactive brokers, in that case, it were only about 100 Swiss francs that should not have been declared as an income. But maybe you have a lot of more shares, and we're talking about 1,000 Swiss francs that
Yeah.
not be taxed. And if you declare them as an income and the tax authorities don't review it properly and just tax it,
Yeah.
say you have 15 or 20% tax rate on that.
Oh, yeah. Yeah.
It's already more expensive than the tax
Yeah,
report
it's
would have.
easier to make mistakes, right? And
Yeah,
even for, you mentioned, for some like for tax authorities, sometimes, people, we're human beings.
yeah,
There's human errors.
yeah, and they're not that familiar often with foreign statements. So
Yeah.
they're familiar with Swissquote,
Yeah.
UBS, and all that Swiss banks, because you see them in almost every tax return.
Yeah.
But things like interactive brokers or any other foreign banks are not that common for Swiss investors. And
Yeah. And the documents are in English or in some other, different languages, and make things even probably even more complicated for those local authorities. And Kevin used to work for tax authorities. You know much better than anyone does. Okay, so for this tutorial, the share screen, is there anything we missing for the IB or Swiss code? I
we're
think we're
good.
pretty
So
much, yeah.
I
So
would,
these are the numbers that we just calculate, and then you should put it there.
exactly. So,
Okay, great. I think before we let you go, there are still some questions, I would say, quite important things, like regarding tax optimization and crypto investment tax. And maybe it's okay. We continue our conversation, Kevin.
sure.
Okay, so the next, the next question I prepared for you is on the tax optimization through investment location. So, like, it's something that we touch on briefly, already. So when we talk about us, like Swiss residents, like we live in Switzerland, is it more tax efficient to invest via Swiss domicile funds or foreign ones?
So as you say, efficient.
Yeah.
Yeah, I would say Swiss domicile, as you can save yourself the time to claim back any foreign withholding tax. And you are sure you're not always sure that you can claim back the whole amount, as we discussed, depending on your private situation, on your other income and the tax burden you have. But there are other countries like Luxembourg, for example, which do not have a withholding tax as well, and therefore, you don't have that effort for claiming back a foreign withholding tax. Anyway, as you just have seen, it's not that complicated to report it properly and claim it back, but it takes some time, and therefore it's easier to invest in Swiss domicile funds. But in my opinion, as we also already discussed,
Yeah.
tax are not the main point
It's
when it
not the primary reason. Exactly. Yeah, I totally agree with you. So I would say, first of all, really taxes shouldn't be your primary reason when you invest. You really need to, do a proper asset allocation strategy or investment strategy based on your goals, and then you optimize for tax. And secondly, you can always reclaim this kind of withholding tax back unless it's really, really little, like less than 100. Otherwise, I would say, for example, if you invest in Switzerland, Swiss domicile or Luxembourg domicile, it could be a bit easier, but it doesn't mean you pay less tax.
Exactly. Yeah.
Okay.
And as we have said, in the end, you don't need to look at your taxes, and your goal does not have to be to pay as less tax as possible.
Tax as possible, yeah.
Your goal needs to be to have the highest return on investment after tax. So
Yeah, exactly.
that's the point here.
Yeah, so that's kind of my job as an investment coach.
Exactly.
Okay, great, Kevin. So I think, one more thing is, beyond traditional asset classes, for example, like stocks, fixed income. And currently we can see, like, over the past few years, some people start to invest more and more in cryptocurrency, right? Like Bitcoin, Ethereum. And one question I have for you is, like, how should, like, crypto investors document and report their trade staking and use? Is there anything in particular that, from your perspective, you want them to be mindful of?
Yeah. So in contrast to banks, which produce clean reports, as we just have seen, this is often not really regulated at all in case of cryptos. And in addition, cryptos are often simply stored locally in a wallet. And therefore, in this respect, the options for documenting this properly are somewhat limited. So you usually don't get a proper report. If you know that you can generate a clean report at the end of the year, that's great, that's perfect. So then it's basically the same as we have just seen. Otherwise, I recommend taking a screenshot of
Okay.
your investments at the end of the year, so that you at least have some kind of documentation that you could submit with your tax return. Another complicating factor here is that many cryptos are traded on different exchanges with slightly different values at the end of the year. So which value should you take? Fortunately, the Federal Tax Administration of Switzerland assesses the most common cryptos and publishes the official values at the end of the year. So this really helps. And in most cases, these are already stored in the tax declaration software of the canton. So you just need to declare the number of, let's say, Bitcoins you have, and it already calculates its value.
Yeah. And some people, I know it's not illegal. It's not legal, sorry. And people say, "Oh, it's Bitcoin, this kind of thing are decentralized, right? Maybe I don't, declare it at all." So, what would you say, Kevin?
Yeah. So yeah, I think there are 2 points. One is that they're currently discussing
Mhm.
an automatic information exchange could
Mhm.
come, so that the tax authorities will receive that information, because
Well,
those
okay.
cryptos are traded somewhere, and therefore some regulations could come and some information exchange could come as well. I don't know when. I'm not 100% sure that it will come, but it's quite likely.
Okay.
The other point is that at some point you probably would like to sell your crypto and get Swiss francs, USD, whatever, to make some other investments, to buy a property, or just to cover your cost of living. and at that point, all the money gets back to your
Suddenly,
investment.
yeah. Mm-hmm.
And if from 1 year to the next year, your declared wealth in the tax return arises from, let's say, 100,000 to 1,000,000 Swiss franc,
Mm-hmm. Mm-hmm.
but you only declare a salary of 200,000,
Yeah.
this will lead to questions.
Problems, right? Yeah.
Yeah.
So in short, don't play with tax authorities.
Yeah, and also as we have discussed earlier, we're only talking here about wealth tax. Switzerland also doesn't tax capital gains on private investments in crypto. So it's only the wealth tax, which is so low.
0.1%. Yeah.
So the impact on the wealth tax here is really
It's minimum, right? Yeah.
compared to the problems you get when
they find you. Yes, exactly. Don't play with tax authorities. Just be honest here if you have cryptocurrencies. And Kevin, one last question before I let you go is about tax efficient withdrawal strategies when it comes to pension. So we know that in Switzerland we have first pillar, second pillar, third pillar, and I know we can talk for hours when it comes to pension planning. And maybe you can just share with us some like little tips and tricks here and there. Like for those approaching retirement, you need to withdraw like the account from, for example, second or third pillar, right? The first pillar you cannot control. And what are the let's say smart ways to draw down investments while minimizing taxes?
Yeah. So as you've already said, first pillar you cannot optimize at all.
First pillar you cannot. Yeah.
You just receive your pension. That's it.
Mm-hmm.
But maybe what you can do in the second pillar is you can have several accounts and you can close them annually after the age of 60. So you don't put all your money just on one account, but you split it between, let's say, 5 accounts.
You are talking about third pillar, right?
Third pillar, correct.
Yeah. Mm-hmm.
Because this way you are always in a low tax bracket when you withdraw it.
Mm-hmm.
Because if you close several pension accounts, including the pension fund, so pillar 3A and second pillar, in 1 year, they are added together to calculate the applicable tax rate, and this results then in a higher tax burden. But if you have like 5 accounts, you can withdraw the money from each account, one with 60, one with 61, 62, 63, and that way you're always in a quite low tax bracket.
Yeah. And in Switzerland, how many accounts that can one person have? Can you have like 20, 100 different accounts? You cannot, right?
To be honest, I'm not sure if there's a legal limit, but it doesn't make sense to have like 20.
Too many. Yeah.
Because you need to withdraw the money usually until you're 65. It depends if you keep on working after 65, but so it's limited to those 5 years after 60 where you could close the accounts. So it doesn't make sense to have like 15 accounts. So you need to close 3 per year because then it will be added.
The same, right? Yeah, exactly.
So
and when you say accounts, it doesn't mean that you need to have 5 different providers. Like we just want to make it clear. You can with, for example, just one provider and have 5 different accounts with them. Yeah. Exactly.
Yeah, but you can't have just one account at the provider and withdraw only a part of it. You really need to close those accounts when you retire.
Yeah.
Therefore, you need different accounts.
Yeah. For example, you cannot close this account just 20%. If you have 5 accounts, like one by one is okay, but not 20% of one of them.
Exactly. Yeah. So that's why I say let's 5 or the most tax efficient. Also, if you have 3, for example, that's already fine because the taxes on this are quite low, or when you withdraw the money from your Pillar 3A accounts, and if you can already split it between 2 or 3 years, the effect there is the highest compared to the effective of an additional fifth account. But yeah,
and in general, you advise people maybe to have 3 to 5 accounts. You think is it's ideal. It's quite optimized. And for example, if some people they invest really well, let's say over the past 40 years, and they have, let's say, 1 million in their third pillar, I think definitely will be the case, or even more. And every single year, I think the maximum for a normal employee is 7,200 something, right? Currently in 2025, and then
7,258.
58, and then they have like 1 million or more than 1 million after the 40 years, and maybe like in 5 accounts, 200K here, 200K there, spread it out. It definitely will be more optimized than you have everything just in one account.
Yeah, exactly. Usually you don't have that high amounts in your third pillar, like 1 million, because it's a relatively new thing, and it's voluntarily, it's not mandatory that you contribute. So for example, when you're young, you don't really care about your third pillar. So
I see a lot of my students, like, for example, they say, third pillar is a scam. I said, no, it's not a scam.
No, it's no scam at all. It makes absolutely sense from a tax perspective. But then again, it only makes sense when you really have an income in that year. So if you're a student and you don't have a taxable income, you don't need to pay anything into your third pillar, because you don't have any tax benefit in that year, but it will be taxed then when you're 65, regardless if you had a tax benefit 30 years ago. So
exactly. And then you have the liquidity risk, right? And then you don't have the tax benefits. Then it's another topic, but it's definitely good to know. And Kevin, how about the second pillar? Is there any way that second pillar, a lot of people, we just call it pension funds, directly. So is there any ways that you advise people to be, like, you can optimize here as well?
Yeah, and in Switzerland, you can choose between a pension and a lump sum withdrawal.
The pension, you mean like every month you receive a certain amount, right?
Exactly, monthly payments. In addition, most pension funds offer a mix, or for example, a partial pension where a lump sum is withdrawn like 2 or 3 years before the normal retirement age. And this may also put you in a lower tax bracket. However, you will then have to reduce your workload accordingly. So
can you give us an example, for example? Like, if you're currently 55.
So if you're 60 and let's say you have 2 million in your pension fund.
Pillar. Okay.
You could say, I will reduce my my workload at the age of 62 to 50%. So you only withdraw 50% then as a lump sum at that moment, which is in a lower tax bracket than the 2 million would be, and the rest you receive maybe as a pension, like the monthly payments at the age of 65. So there are really a lot of options there, but there are also a lot of regulations. So this is a topic that we need to review with
individually, right? Like, for example, when you say, I'm still working, I'm currently 60 years old, for example, and I'm still working and I want to withdraw the second pillar earlier than 65. And for example, at 62 or 63, And in order, to avoid at 65 withdrawing everything, right, or taking the kind of like the monthly payout, and then I want to have it a bit earlier, like let's just say 20% or 30% at 62. But like you mentioned, you have to, meet some requirements. For example, you cannot just withdraw the 20% without and you're still working 100%. You have to reduce your workload. But it can kind of optimize your tax, I would say, overall speaking. So it depends on, what you think is worth it. And then at 65 years old, you already kind of like previously at 62, you withdraw some money, right? And then at 65, you receive the monthly payout. This could be one of the few ways to optimize your second pillar. But like Kevin mentioned, it really depends on single, like individual cases here.
Yeah, and I think you often have that discussion, what is better to receive the pension, like the monthly pension payments, or if you should just withdraw the money
lump sum.
lump sum. But in my opinion, the taxes here, it's also the same as when we're talking about the investment. It's really secondary for me. Primarily, it's about what you feel more comfortable with. If you would like a monthly income, you should not look at the tax burden. Then you're for sure happier with the pension. And if you choose the lump sum, it also depends then what you're doing with all that money. Usually we're talking about more than 1 million Swiss francs. If you're not investing it properly and you only have it on a bank account with often 0% interest, it doesn't make sense at all. So
yeah. It really depends on, quite a few factors. And what I, keep telling my friends or my students, my audience, like, for example, like what Kevin said, it's always like opportunity cost, right? If you really know how to make the money work for you, and if you have a proper kind of like investment strategy, you can definitely make the money, earn you 6, 7, 8, or even 10% annually. But if you don't know how to make the money work for you, you don't know how to invest, you just have the lump sum and put in the bank, then you'd rather have maybe the monthly income. And also, it can also depend on your health factors, right? For example, if I don't want to say I'm dying, but maybe I'm not in a very good health situation, I will need kind of the lump sum. I want to enjoy my life. You may want to consider a lump sum, right? If you think, I can live until 90, 100, 120 years old, maybe you want to consider more like a monthly payout. So it depends on kind of like a lot of individual factors, like also what Kevin mentioned. In this regards, definitely your own life goals or your investment goals, this kind of thing is more important than tax consideration. And here tax should be only, your secondary consideration instead of your primary concern.
Exactly. Yeah. Perfect summary.
Yeah. Thank you so much, Kevin. Today I think we definitely learned a lot from you. Is there anything like you wanted to add? Is there anything we missed?
No, I think we've covered most of
pretty much everything about investment. Yeah. Okay, great. And I will, we will let our audience know, where to find you. We'll include your LinkedIn, link in the description, of this video as well. And until then, take care, everyone. And thanks so much, Kevin, for being here today.
Yeah. Thank you for having me. It was a pleasure. And hopefully we see each other in another podcast.
In another episode.